Good morning, Mexico.
Good morning.
So we've got about an hour-long presentation. Obviously, if you have any questions, just direct them to Marie, and she will pause me, start me, or stop me, or whatever. I'm on to the disclaimer. Obviously, this presentation can't be, everything for everybody. It's intended to be an overall view of some of the issues, or the majority of the issues that cover moving to Mexico, owning property in Mexico, and such. Obviously, I suggest seeking a competent tax advisor to discuss the specifics of your particular situation. Next slide and get started. Okay, so the first thing you want to understand is you want to kind of clarify terms. We want to understand what you are. And a lot of people might be vacation or business travelers. They might be just short-term, less than a year. That'd be a vacation or a business traveler. An expatriate is somebody that goes for a long-term move, but not necessarily permanent. So it would be greater than a year, but less than permanent. Expatriation is permanent. That's giving up your U.S. citizenship. You're no longer a U.S. citizen and maybe obtaining a Mexican citizenship. So that's just a little bit of clarification of terms. So as we go through and we talk about different things, we understand, what exactly we're talking about. So I'm on to the next
Oh, just a second. Okay, a question here. Just a sec.
Not giving up citizenship, it's giving up residency.
He's saying that rather than giving up U.S. citizenship, it's more like giving up residency there. But you can actually give up your citizenship so that you're not in the tax system, and that's what some people do, not very many.
It cost you $500,000 as of 2007 to do that.
Wow.
You can do it for $100,000.
Okay.
Okay,
All right. We'll say that for another time.
Yeah, we're going to talk a little bit about expatriation in a little bit, but there's no such thing from a U.S. perspective of giving up U.S. residency. It's expatriation. It's giving up your citizenship. And we'll talk about that a little bit more because in the U.S. you're taxed on all worldwide income from all sources derived. So you don't give up residency unless you give up your citizenship. But we'll talk about that a little bit more later. So I'm on to the next slide, U.S. short-term travelers. So if you're a short-term traveler, it's just like a normal U.S. tax return. There's no special issue. It's just like a business traveler or personal expenses. So if you're on a business trip and you have some business expenses, they go to Schedule A and/or Form 2106. So there's no real big difference for a U.S. short-term expat. On to the next slide. This is probably more along your lines of the crowd that I'm talking to today. Long-term expats, but not necessarily giving up their U.S. citizenship, not expatriating. There's three things you can use to avoid double taxation. The foreign earned income and housing exclusion, that's Internal Revenue Code Section 911, has nothing to do with September 11th, was around a long time before that. That's the big earned income exclusion. That is like wages and commissions and bonuses and stuff like that. In 2010, you'll be able to exclude $91,500. If that's not enough to exclude all of your earned wage income, then you can also use foreign tax credits. In other words, the taxes paid in Mexico can be used to offset the U.S. taxes. And foreign tax credits can also be used to offset interest, dividends, and capital gains. If those two items alone don't help reduce or eliminate the double taxation, then there's a treaty between the U.S. and Mexico that usually will wipe out the rest of the income. Now, there's not a dollar for dollar reduction of income. You will end up paying more taxes. You will be double taxed, but hopefully with these three items, it'll help minimize the double taxation. Keep in mind the primary reduction of wage type income is the foreign earned income and foreign tax credits. I'm on to the next slide, and now we're on to the expatriation. Again, the U.S. taxes all worldwide income from all sources derived, and you must show all the income on your U.S. tax return and then through the U.S. code, you can help reduce it or eliminate it, but it first must be shown on your U.S. tax return. So some people come to the point where they say, okay, I've had enough of the U.S. tax regime, so I'm going to go ahead and expatriate. I'm going to leave the U.S. and be done with it and no more taxes in the U.S. Well, here's a short little version on what you'd have to do to give up your U.S. citizenship and permanently expatriate. First, you must obtain citizenship in another country, i.e. Mexico. Then you would give up your U.S. citizenship. You'd go to the U.S. consulate in Mexico, or you could even do it in the U.S., and you formally fill out forms and say, okay, I'm giving up my U.S. citizenship. And then at that point, when you deem that you're giving up your U.S. citizenship, all of your assets are deemed sold. There's a mark-to-market adjustment for your assets, and whatever gain there is on all your U.S. assets, they would be taxed at that time. And then, for the next 5 years, you would continue to file a form. It's a special form, Form 8854. And what this form does is it's a very complex form. It's like a corporate tax return. It's got a balance sheet and a profit and loss and all that kind of stuff, just proving to the IRS, the U.S. IRS, that you're not giving up your citizenship to avoid taxation. Yeah, I kind of expected that. Obviously, it's a mess, so you're going to want to contact an attorney before you really seriously consider doing this. And the other thing I strongly suggest is, before you go down the route of the permanent expatriation, is try the long-term expat first. Try filling out the forms, see where your tax situation sits. It may be just the expense of preparing the U.S. returns versus any actual U.S. tax liability. With exclusions and credits and whatever else, there may not be much of any U.S. tax liability. And if that's the case, then you might want to try that route, at least for a while. And then if you find that it's just not worth it, then go ahead and contact an attorney and give up your U.S. citizenship.
Oh, just one question.
Go ahead.
If you are a long-term expat, can you absentee ballot vote in the U.S.?
Yes.
Can you have it?
Yes.
That's it?
Yep.
Okay, let's go on to the next slide then. Talking about non-U.S. home ownership. Basically, it's just like owning a U.S. home. There's a few little nuances, and we'll cover those, but nothing real big and exciting. The bad news is the U.S. is one of the only countries in the world that taxes their citizens on all worldwide income from all sources derived. The good news is, especially with rentals, all the expenses and losses, or most of the expenses and losses, are deductible. So if we go on to the next slide, talking about itemized deductions, and a lot of U.S. taxpayers are very familiar with this. Your Mexican mortgage interest would still be deductible on Schedule A. Your Mexican real estate taxes are still deductible on Schedule A. And don't forget, the U.S. has limits on these. The $2 million or the $1 million home limit and the $100,000 home equity limit, and you can only deduct 2 homes, your main home and your second home. So if you've got a home in Mexico and you've got a home in the U.S., those are the only 2 you're going to be able to deduct. You can't take a third primary residence or secondary residence. And the other fortunate thing is, if you got more than 2 homes, you can move them around from year to year and take the greater expense as a deduction. Any questions about the easy stuff?
Nope.
This is an easy crowd today. Are they awake?
Yeah, almost.
All right. Well, let's go on to the next slide, rental property, and let's talk about that. Let's consider, instead of owning the property or living in the property as a second home or a primary home, possibly buying the Mexican property and renting it. Again, mortgage interest is deductible. Real estate taxes are deductible. Any income taxes you might pay in Mexico would be deductible. And then you got all the other special rental expenses. Insurance you can now take, repairs and maintenance you can take. And here's a big ding, ding, ding for you. You might want to circle this. Marie, were you able to print off a copy for them?
Yes.
Okay, great. You might want to circle this. Trips to maintain and repair the property would be deductible. Okay, now obviously you want that to be the only primary purpose of your trip. You don't want to spend 6 months down there cleaning it because that'd be a little strange, but if you came in for the weekend or a long weekend or whatnot to repair or clean or maintain the property, that all those expenses for flying in would be deductible. And then we get depreciation as deductible, and just about everything else that you can allocate directly to the rental would be deductible. So just like a property in the U.S. that you rent, most rental properties generate a loss. That loss would be deductible against your other income. We'll talk about that more in a minute. Does anybody have any questions about renting Mexican property? Well, I'm on to the depreciation slide.
Okay.
And depreciation is an expense that you can help to offset your rental income. What it is it's considered a loss of value due to time. So if you own the property, just sitting there, that building, it's losing value as it sits. Hopefully with the market, actually it grows, but from the IRS perspective, it's losing time. It's losing value. Depreciation for non-U.S. properties is very simple. It's straight line over 40 years. There's no special makers or acres or accelerated cost recovery systems and all these things that you need calculators to figure out. You simply take the value of the property, divide it by 40, and that's the amount you take per year. Very simple calculation. One thing to think about with depreciation is a timing thing. The U.S. is allowing you a deduction now for something later on that you're going to have to add back into income. Now, a lot of times people will say, well, if that's the case, if I have to add it back into income or recapture it back in, then I don't want to bother taking it at all. And if you go that route, that's fine. That's perfectly that's up to your discretion. However, when you calculate recapture at the end of the useful life of the property, the IRS mandates that you take the greater of what you actually took or what you could have taken. And if that's the case, then you might as well just take it all. Great. Let's go on to the next one then. We're still on rental properties. This is talking about passive activity losses. And basically, you can take your rental expenses, and if they're greater than your rental income, the losses can be used to offset other income like interest, dividends, capital gains, and wages. So somebody else is paying for your property, and by paying for the property, you're still ending up at a cash or a tax value loss, and then this loss can be used to offset other income. So it's a great investment vehicle for a lot of people. However, the losses are limited to $25,000 per year. You can't take more than $25,000 per year cumulatively on all your rental properties. And unfortunately, it phases out entirely at $150,000 of total income. So some of the people that can actually invest in multiple properties with higher levels of income don't get the losses to offset their other income. Now, the losses will cap at the rental income, so you won't be generating taxable income from your rental, which is a good benefit. And then the last part about it is when you sell the property, you free up the unused losses or the carryover losses. And they carry over indefinitely, not like, limit on, 10-year carryovers and whatever else. These losses carry over indefinitely. All right. And back another side note, on date of death, if your asset transfers over to somebody else, your losses would be lost. They would evaporate into thin air. Any questions about the fun, exciting passive activity loss limitation rules?
Nope.
All right. Let's go on to personal use. Okay, so if you decide to rent the property and use it for personal use, be sure to track your days of use. The total days you have it available for rent, the total days it was actually rented, and the total days you personally used it. There's special rules on personal use, and there's allocations and whatever. There's also like a 10-day limit. If you personally use it 10 days, then it doesn't matter. It's not a big issue. But if you use it greater than that, then there's all kinds of allocating the expense between personal and business and such. But the important thing is, if you decide to rent and use it, then be sure to track your days. And again, you might want to circle this, ding, 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 unless you're cleaning and repairing it. All right?
How long can you clean and repair?
How long can you clean and repair, Chuck?
Well, you know, you got to say reasonable. But when you say IRS and reasonable in the same sentence, people start to laugh. So, you know, I don't know what the answer is. I think there's a big difference between a weekend cleaning and a 6-month cleaning. Anywhere in between there, you know, becomes questionable. But what we see here in the Southeast, in the Atlanta area, is a lot of people will buy vacation properties, and they will rent them out, and then they will go up on the weekends in between the rentals, and they'll clean them. But they'll also be, you know, obviously using them. So they might go up for a long week and use it like Friday, Saturday, and Sunday, and clean it at the same time. Any questions?
Nope.
All right, well, let's go on to the next slide. I'm on to exchange rates. Okay, you U.S. taxpayers, you all know that your U.S. tax return is denominated in U.S. dollars. So all payments and all receipts must be exchanged to U.S. dollars for inclusion on your U.S. return. Now, technically, you should exchange the transaction on the date of the transaction. So say, for example, somebody paid you rent on the 4th. Well, then you'd have to go and exchange that rental income on the 4th. And say somebody came in on the 12th and cleaned the rental property for you. Well, then you'd have to exchange that payment that you made to U.S. dollars on the 12th. Practically, nobody does that. We pick an average exchange rate for the entire year, and then we use that average exchange rate for all the transactions on your U.S. return. The big tip here is you can't pick and choose. You can't say, well, I had this huge capital gain on the 15th, and the exchange rate was really low on that date, so I'm going to take the 15th for that one, but then I'm going to use the average for everything else. You've just got to be consistent with whatever you do. There's a wonderful site out there, owanda.com. It's got, if you look in the lower left corner, it's got a little link for historical exchange rates, and you can put in the beginning period, the end period, the different exchange rates. Press go, and it gives you this great big table of all the exchange rates for that period, and then it gives you the average at the bottom. Any questions?
No.
All right, well, let's go on then. Let's talk about the foreign mortgage gain. Can everybody see that in a word? Yuck. Okay, this is the most ridiculous rule I've ever heard of, but it's out there, and I really need to warn you of it so that you're prepared if it does come across. Basically what happens is the IRS looks at a foreign mortgage as a hedge. Hedging is buying foreign currencies, holding them until the exchange rate changes such that there's a gain, and then trading them back out. So they look at it like an investment vehicle. So it occurs when you substantially buy down the mortgage. What does substantially mean? I don't know, but everybody agrees if you pay off the mortgage, it's been substantially bought down. So you calculate the exchange rate and you calculate the basis. The difference between the basis and the exchange rate generates a gain or a loss. Now here's the most ridiculous thing I've ever heard. Gains are taxable. We all know that, right? Losses are considered personal and are not deductible. Right. So you've got to be careful with this. If you come across a situation where you're going to sell the property, you've got to look back at the exchange rates and make sure that you don't have a gain. If you do have a gain, they are taxable. If you have a loss, you don't even show them on the tax return. All right?
Except, let me just add one thing. Banamex is now owned by a U.S. bank, and they are now issuing 1099s.
Well,
that would be the exception.
But also, there is another special thing about Banamex, though. What I understand is you can buy your mortgage in U.S. dollars. Isn't that correct?
Yes.
Well, if that's the case, if you bought it in U.S. dollars and you sold it in U.S. dollars through Banamex, the mortgage is in U.S. dollars, then there is no foreign mortgage gain.
Ah, interesting.
Yeah.
He said that if you are buying your property in U.S. dollars and you're getting a mortgage, say, through Banamex in U.S. dollars, then there's no foreign gain to report. One question.
A loss on the currency exchange is not deductible.
Correct.
But you can still write off losses on property.
The capital gain, right.
Yeah. Right.
Correct.
So does this only apply if you're renting the property? I don't understand it.
No, it's not whether you're renting it. You might get a mortgage for you to live in it. So it's basically a foreign mortgage that the rule applies to.
And if you don't get a mortgage, it's not applicable.
That's right.
That's
Yeah, if you pay cash, it's not applicable.
Correct.
Yep, we're clear.
All right, well, let's go on to the next one. It's qualified business unit, and it's still surrounding the foreign mortgage gain loss situation. This is another way, other than Vantis U.S. mortgages. This is another way around the foreign mortgage gain issue. Basically, what you're doing is every year you prepare your return, you're adjusting the basis of the property for depreciation purposes, and you're putting a note on that asset that goes to the tax authorities that it's a QBU, a qualified business unit. And supposedly, this will avoid the foreign mortgage gain issue. I think it's risky. I worked for Arthur Andersen before Arthur Andersen closed. I also worked for Price Waterhouse. And no other Big 4 or Big 5 firm does this other than Ernst & Young. I've seen arguments on both sides of it. I don't necessarily agree with it. Okay, let's go on to the next one. It's incorporate the rental. A lot of people buy properties and then they go through the old version of incorporating, or they ask the question about incorporating. And I like to tell a story about when I first started working in accounting. I worked in an accounting firm in downtown Atlanta. It had 2 partners, 3 managers, and me, little old staff intern Chuck. And one day we had a guy come in, and he was setting up his business, and it was just a small sole proprietor type business. And we talked to him for like an hour or whatnot, and the partner went through the whole spiel and set him up. I think it was a S corporation, I believe. And then we got all his personal information, do his personal return as well. And then he left. And when he left, I sat there and I talked to the old partner. And I said, I don't understand why we set up this corporate return. He could have easily put that on Schedule C and would have been a lot less complicated, would have saved him a lot more prepare fees, would have just been a lot easier way to go. And would have had the same benefits of having the S corporation, the limited liability corporations and all that jazz. And the partner asked me, he's a chain smoker, he's like 90 years old, and he sat there and he asked me, he says, Chucky, he always called me Chucky, I don't know why, maybe because I was grandson to him, but he said, Chucky, how much do we charge for a personal return? And I said, I don't know, $500, $600 bucks. And he said, how much do we charge for a corporate return? And I said, I don't know, $1,500. And he said, why would I let that man walk out of my office with my $1,500? So that's where I am with this incorporating. If you feel that incorporating your rental property will give you some kind of legal liability protection, then by all means go ahead and incorporate, pay your tax advisor extra money to prepare all these international corporate returns. Or what you could do is you could go out and get rental insurance, because that's what rental insurance is for. And on top of that, do you really think the U.S. government is going to provide you any kind of legal liability insurance? But there's lots of forms out there. One form you might want to look at is if you do incorporate, say for example you're going to incorporate in Mexico, then you have to, on your personal return, fill out this form 5471, which is a Mexican corp for a U.S. investor. And then if you wanted to fill out actual, incorporate or actually incorporate the return like in the U.S., then you could fill out the 8858 or the 8865, depending on which partnership you were set or which corp you were setting up. Very complex issues, very specialized preparers to handle those.
Can I add something, Chuck?
Sure.
The other issue, of course, for when you're in Mexico is if you incorporate and put your property in the incorporation, you are no longer exempt from the capital gains tax.
Ooh.
So most people don't want to do it.
Yeah, you don't want to lose out on that from the Mexican perspective. Of course, you can never do that in the U.S. Everything's taxable in the U.S. All right, let's go on to the next one. And I kind of alluded to this earlier. It's the foreign bank account return. We've been preparing this return for several years. I've been doing this for almost 15 years, and I've always had to do it, so it's been around for more than 15 years. You'll likely have to look into this. And basically what it is, if you own non-U.S. bank accounts that do not exceed a balance of 10,000 U.S. dollars during the year, then at the bottom of your Schedule B on your personal return, Schedule B is interest and dividends. At the bottom of the return, you have to check the box that you own a foreign bank account, but the balances never exceeded $10,000 during the year. And then you would list out what countries the bank accounts are in. It might be Mexico or Italy or whatever they are. Now, if the aggregate value of all your non-U.S. bank accounts exceed 10,000 U.S. dollars at any point in time during the year, then you are required to file the foreign bank account return. It's a fairly simple return. It just lists out the name of the bank, the highest value it ever reached during the year, the account number, and the address of the bank account. The form is TDF 90-20.1. It's due June 30th. There are no extensions, and there is no tax calculated on this form or related to the form. The IRS just wants to know where U.S. taxpayers have their money. This way, they can catch drug dealers, money launderers, and terrorists.
We don't believe that either. Tracking the average citizen.
Well, here's the thing. The IRS is starting to break through foreign bank accounts. For example, we all thought Switzerland, you could put your money in Switzerland and the IRS would never find out about it, right? Well, the IRS, like 3 years ago, broke through to USB. And they now have a list of U.S. taxpayers, their account numbers, and their balances. And all these people that never reported those balances are paying huge fines. One of the fines for failure to file this bank account return, one fine, because there is no penalties or interest assessed, there's no tax liability, they have to assess a fixed fee, right? So the fine is $10,000 per account not reported. And then they also have another fine, which includes jail time. So I think it's kind of easy form to fill out, and I would just fill it out and send it in, let the IRS know where they are. before the IRS breaks through another bank account and gets somebody else's account numbers and balances.
Just a question, Chuck?
Yes, go ahead.
Chuck, there's no tax associated with filling out this form, but isn't there another thing that then having more dots for their picture, then they have the address of the bank and assume that there's some interest-bearing feature to the example.
Did you hear that, Chuck?
I got parts of it. Can you summarize it for me?
Is it not, when you're putting that money in, there's no tax due on it? However, does it not just connect more dots so that now they've got the bank account number and the name of the bank, so they can surmise that there's likely an interest-bearing account that may or may not be reported?
Absolutely correct, and that was my point earlier, is the IRS is putting the dots together. They're figuring it out. One of the things we're not clear about on this foreign bank account return is, are you supposed to put a foreign mortgage on it? Are you supposed to list mortgage on it? Because it's not just cash accounts. They want credit card accounts, which are very clear about, but we don't know. Are you supposed to put foreign mortgage on there? Now, my clients, I advise them, just like I'm advising you now, that this is out there. Failure to file includes $10,000 per account not notified or identified. If it were me, I'd like to sleep at night, so I would put the foreign mortgage on there. And then, like you said before about throwing up the red flags, the IRS already has the information. They already have it because you provided it to them on this form. So if you go the QBU route, the Qualified Business Unit route, and you want to put that on there to avoid any kind of foreign mortgage gain, well, the IRS already knows because you put the foreign mortgage on the foreign bank account return. But at least this way you're following their rules, and you can sleep at night. You don't have to worry about some kind of crazy IRS notice.
Okay, another question?
Go ahead.
So Chuck, are you saying that every June the 30th you have to file this, no exception? So if I opened up a foreign bank account in April of this year, I should have filed a form on June 30th?
No, this is a calendar year form. So the 2010 calendar year would be reported on the June 30th form. So you've got time. You're fine.
Okay.
We all set?
Mm-hmm. Yeah.
All right. Well, let's go ahead and move on to the next slide. Before, one of the issues came up, our previous was the new healthcare law, and I actually went to a training on the healthcare law. The big thing to understand about the healthcare law is that it's all corporate tax issues, except for the adoption credit was increased, and the tax-free reimbursements on over-the-counter drugs, there's a change to that. Okay? Individuals have no issues with this healthcare law. There's no additional forms. There's nothing we have to do for the healthcare law. And the other thing to keep in mind too is this is the laws that are coming out of it are going to be expended over several years. Like we're not going to take the full effect of it until like 2014 or something like that. Individuals, we as individuals will feel the effect through corporations passing down cost and other changes. Like the increased time children can remain on the parents' plans. That just means the insurance companies are going to raise their prices. Your company, your employer, if you're getting W-2 still, will have to report the amount of insurance that they and you pay on your Form W-2. You know, in the box 12 where it's got the code A, B, C, P, Q, W, X, Y, Z, that's where they'll report that additional information. There'll be annual fees that branded prescription companies have to pay. And that just means they'll just raise their prices and we'll pay it through them. But we don't have to fill out any other forms or do anything. And then there's tax breaks for health organizations. Anything else there?
No, I think that's good.
Okay, I'm going to digress off of the presentation just for a second. I have some emailed questions here I just want to take a quick look at. And one of them was, must all income earned here, i.e. rental income, be reported? As a U.S. taxpayer, yes, all worldwide income should be reported on your U.S. tax return. Or I will say must. I will answer that with a must. If you choose not to, that's your risk. But the law is U.S. taxpayers report all worldwide income. Then I have another question here. If we're not doing any business from our Mexican residence, does the U.S. government need to know we own the property here? That's kind of a tricky question. If you own the property there, you're not providing any kind of report to the IRS saying that you own Mexican property. But if you have a mortgage there, you should probably put that on your foreign bank account. And if you're paying taxes or insurance or mortgage interest, then you can deduct that on either your Schedule A, itemized deductions, or you can report it on your Schedule E, rental expenses. So it's kind of a trick question because you're not reporting that you have Mexican property, but at the same time, you're still reporting the ancillary information around it. Any questions?
No, looks clear.
All right, let's get back to the PowerPoint then. And we're done with healthcare, so let's go on to the next one. Oh, okay, closing. Although there's a lot of little things here that might be confusing to the common taxpayer, this is really common practice for people that specialize in international tax or expatriate tax. So I don't want you to think that it's just unruly and you can't do it because you can't understand the tax effects. A couple of years of assisting your tax advisor in preparing this, and you'll get it down pat. It won't be any different than preparing your U.S. tax return. My best advice is to seek a competent international or expat consultant to review your specific case in detail prior to the end of the year, prior to you doing anything crazy, and then go from there. The big thing I like to tell my clients is you can treat me as a historian or you can treat me as a consultant. If you wait until the end of the year and you provide me a shoebox full of stuff and say, here you go, all I am is a historian. I take the facts of the year and I put it on your historical tax return. Or you can talk to me before you do something and treat me like a consultant, and I can advise and help you, save money and sleep at night. And that's about it. I'm on to questions now.
Yeah, and question here.
Okay, well, if my husband and I retire here, we would get Social Security. We also have IRAs, that sort of thing. If we're doing distributions of that, so presumably, okay, they would go on the basis of what is our Social Security income and what are we getting in distribution, and that's it.
Could you hear that, Chuck?
No, can you repeat the question, please?
Yeah, if her and her husband move here full-time and they're collecting their Social Security and distributions from IRAs, pensions, 401k, it's just as simple as reporting that and there's nothing further involved?
Really, that it's very simple, that there's nothing special to your U.S. tax return there. However, a competent advisor would help you and fill out your FBAR for you, your foreign bank account return. And then they would also look at your home expenses there, your mortgage interest and real estate taxes, and help you track your foreign mortgage gain, if any.
I've been thinking if we do it, we have Schwab accounts and accounts with other financial institutions in the state, kind of leaving it there, instead of.
Yeah, you don't have to move them. There's no issue there. Remember, you're a U.S. taxpayer, and all of your income is reported on your U.S. tax return. So having a U.S. bank account or a Swiss bank account or investment account, it doesn't matter. It doesn't matter where you move it. It's still going to be reported on your U.S. tax return, so there's no reason to worry about moving stuff until such time that you think it's going to be a gain. You know, if you think that you're going to generate a gain, by all means, move it.
Any other questions? No, I think we covered it.
All right.
Okay, thank you very, very much.
Thank you all. Take care.